when we say that we think the Fed is going to keep rates higher than what the current markets are expecting recession with these rate cuts. But if inflation is turning around, and we believe it is, for the systemic risk of ever widening federal budget deficits, but also geopolitical risk is out there as well, which will cause some temporary inflationary bursts in our economy. The Fed isn't going to be able to cut, I think, what the market is anticipating.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. Today I'm going to be speaking with Raach Medlin, who is working in the financial services sector as an economist and risk professional. We had been following each other on LinkedIn, and I came to realize that Raach was a fan or member of the Austrian School of Economics. And I thought, I like talking to people who have real world experience, but also that background in the Austrian tradition. And so I asked if she would come on and talk about her day job and how it intersects with Austrian economics. So besides that curiosity that may interest you, also she just has a lot of good stuff to say about the current state of the economy, credit markets, what the Fed futures market is telling us or not telling us, and so forth. So without further ado, here is my discussion with Raach Medlin. Raach, welcome to the InFi podcast.
Thank you, Bob. Thank you for having me. I really appreciate it.
Yeah, I've been looking forward to this. So normally the conventional wisdom is, get right into the material that's going to entice people. But I just do want to give you a chance to explain. Partly why I wanted to have you on is that you have some relationship to the Austrian School of Economics. And part of what I'm going to be asking you is, how do your views in terms of your day job, how are they influenced by that? And do you have an edge or something because you know Austrian economics? So can you just explain the quick version of how did you come to be familiar with this heterodox school of thought?
Yeah, sure. So I would say that my economic journey really started 20 years ago. I think where most folks get their start in economics is in college, where you're a young 20-something-year-old and you probably have no idea what you want to do with your life. So you go to a business school because you think, I'll make money in business school. Well, I sort of gravitated toward economics relative to looking at finance and accounting and marketing. I just really understood economics. It made sense. It was intuitive. So the concepts of the number one rule of economics, scarcity, when professors would talk about trade-offs and guns and butter in an economy where you have to trade off war in order to have other forms of production and vice versa. So the very first parts of, say, introduction to macroeconomics or introduction to microeconomics really made sense to me. And so I majored in it. But it wasn't until you start to get into the later, I'll call them chapters in economics courses, where you start getting into fiscal and monetary policy. And you start hearing things like, we're going to start smoothing the business cycle. And, at the time, I'm naive, I'm young, I just sort of accept those things as maybe they're not very intuitive to me because I don't understand quite yet. So I kept with economics. I still very much enjoyed the study of the economy. And I got my graduate degree and ended up then plopped in the banking system in 2008 and had very little idea that there was the largest great financial crisis going on all around me. So my journey really began right in the middle of 2008. I was a credit risk analyst. And my job was to basically, they say, you have an economics degree. I need you to look at the economy and help us to project credit losses. I said, great. How do we do that? Well, let's look at vintages. So vintages are just, you take an origination, a pool of loans, and you sort of track them over time, how losses will look. And I say that it's very important because as I'm looking at these charts, I'm noticing something very in particular about losses from credit cards, auto loans, home loans coming particularly from vintages 2005, 2006. And so being relatively green and naive, I start asking questions. Why are we having so many losses? And the folks around me, well into their 50s, veterans within the banking industry, are saying, those are all the bad loans that were originated, especially on mortgages. And I said, okay, well, why are we having all these bad these mortgages go bad? And they said, well, because folks, they didn't really qualify at all in the beginning. And so they had either high debt to income or the value of the home was very high relative to the loan, or their FICO scores weren't that great. And I said, okay, why are we giving all these people loans that aren't going to repay us? And they said, oh, it's okay. We just sell them to Fannie and Freddie.
Mm-hmm.
And I think it was that moment where my understanding of economics, especially with monetary and fiscal policy, started becoming very disenamored, that economics could explain why all these losses were happening. So fast forward, and I know you asked about the Austrian School, I just sort of once again took this all for granted, that the federal government was coming in at the time and handing out TARP loans, and that the Fed was cutting interest rates to zero. Fantastic, right? We've got to save the economy. We've got to save the globe. We have to have QE and low interest rates. And it wasn't until around 2016 where a colleague of mine said, all right, you're an economist. Here you are talking about these relationships between rising unemployment and credit losses and bank portfolios. How does the Federal Reserve set interest rates? And I was like, I didn't have a great answer. Or how does the Federal Reserve help to smooth the business cycle? Long story short, this colleague of mine said, have you heard of Austrian business cycle theory? And I said, no, I have not. And he said, I think you should look into it. And so I did, and the rest is history. So I'll sort of pause there. I know it was a long-winded answer, but I wanted you and the audience to understand that I feel like I represent this sort of cross-section of your standard college student with not a background in any sort of economics. I don't think economics is taught in most high schools. It certainly wasn't in mine, who is sort of plopped in the, quote, real world of seeing how fiscal and monetary policy are impacting what I felt to be a bank who had the incentive to make a loan that would be repaid. And when I'm hearing great, smart people say, oh, we're just going to ship it to Fannie and Freddie, I thought, well, why are we even doing all of this if it's just a big illusion and the federal government's going to bail us out? So yeah, then I started looking into Austrian economics. I found Tom Woods, Peter Schiff. I could name many. I think one of the first books I read was Mark Thornton's The Skyscraper Curse. Mm-hmm. And I don't know, I'm sure you've heard of his book.
Yeah, for the listeners, Mark Thornton, he's an economist, another senior fellow at the Mises Institute. And yeah, he had this index where he said every time they break the world's record for the tallest skyscraper built to date, then pretty soon there's a recession after. And he documents that that's empirically the case, and then gives the theory like, why does that make sense? And it's because it's typically like a cheap credit bubble that allows them to go ahead and borrow a bunch to build what the tallest skyscraper is in the midst of that mania. And then since it is occurring during a bubble, it's not surprising that soon afterward there's a crash.
Exactly. And using that same framework, I'm sort of rewinding the tape on my experiences back in 2008 going, oh, that makes sense. Why all of these loans just happen to go bad all at the same time, and why the corporate greed or bank greed couldn't quite explain. I worked with these people, and it wasn't just we're going to originate loans. There was the incentive structure was so misaligned, especially then, to fool even banks and entrepreneurs. As you know, Austrian business cycle theory tells us that once there are interventionist policies and interest rates are tinkered with and manipulated, then it distorts the price signal. And from a risk perspective, it distorts the risk signal. It says money is free and there is no risk. And I remember going to an economic conference of a very mainstream economist who I will not name, but this person said at the time rates were low and they were in our city, and they said, the city can borrow whatever they want, interest rates are low. And this was still before my Austrian view. And I thought, well, that can't make sense. And I would always tell people, but rates aren't always going to stay low. Isn't there some sort of cost to this? There was a lot of talk about as if there were no cost to artificially lowering the arguably most important price in our economy. And how weird it would be if we had 12 people setting the price of steel. Nobody bats an eye, but we're not even being curious about why this would be a problem for the entire economy in certain sectors alone.
Just to make sure the audience got your point there, Rachel. So she's saying free market economists, rah, rah. Oh yeah, we don't believe in central planning. The Soviet Union collapsed, capitalism for the win. If you had a group, an open market committee that sat around and every month or whatever, every few months had a press release explaining what the price of steel or crude oil was going to be, what their new target was, we would say, you can't do that. That's socialism. Mm-hmm. But yet they do that for interest rates, which are a very important component of just every aspect of the market. So, and yet that's not considered to be central planning. And it's a lot of people like Alan Greenspan, who are head of the Federal Reserve, even though, he's a buddy of Ayn Rand and so forth.
Exactly. So fast forward to, if we want to unpack what I'm doing now and the work I'm doing, because of my sort of disillusionment with my role as an economist working within the credit risk function, trying to provide financial services companies with, if we price our loans in this way, we can maximize the risk reward. We can get the highest rate at the lowest risk. That was effectively my job. But I became disillusioned when I thought, quite candidly, I don't know if any of this matters. I think, and this is going to sound terrible, I think I have a higher calling. And so as I'm getting into this Austrian view of economics, I became obsessed and sort of self-taught via listening to podcasts, listening to your podcasts, listening to Contra Krugman back in the day was like my bread and water at some points, just to really get myself up to speed on this completely different way of looking at the world, that perhaps it's backwards. Perhaps it's not the Federal Reserve that is coming in and saving the day. Perhaps the policy errors, the errors in the economy aren't random at all. And that there is some sort of root cause within the Fed itself. And so that started my work and my understanding. And so 5 or 6 years...
Can I just stop you for a second there, Raach? And for the people listening to this podcast are going to be very sympathetic to what you're saying. But even for a neutral audience who hasn't heard this stuff before, I just want to mention prima facie, to say maybe the business cycle has something to do with Federal Reserve policy makes a lot more sense than to say it's due to corporate greed or something. Because as you say, in terms of the timing, like it's not that, how come loan originators got greedier and more reckless between 2004 and 2006. Right. You know what I mean? It's like, the bankers weren't greedy in 2002 or, 1994. So whereas you can just be more specific about it. And so, maybe it is something to do with Fed policy or whatever the bank's doing. But just to say corporate greed, or these say, you can't trust under capitalism. They have very short-sighted views. You're just trying to post returns for the next report for the shareholders. Okay, but why does that system lead to these wild, boom bust cycles? Like that could just explain why it doesn't work very well, period. So.
Yes. And in a capitalist society, this concentration of risk would have to be overwhelming, that everybody colluded at the same time to all of a sudden be greedy, where back to the original macro and micro 101, you're taught that supply and demand do adjust to prices. And so for a company to be greedy means they could just Nike can go out and double the price of their shoes and keep their same market share. That would be insane. Mm-hmm. So that's the way I sort of explain it to people is when you lower the cost of money, you all of a sudden say, without any change in the underlying fundamentals of the economy, without any changes between the saving decisions of consumers, the investment decisions of consumers, the investment decisions of entrepreneurs, 350 million people, give or take, you didn't change anything about them. You just effectively, by fiat decree, said interest rates are going to be lower, even though people haven't been saving. And so understanding the mechanics of money is what the Austrian School helps us. In a free market, why does the interest rate go down? So then we get into time preferences, which is another fascinating tenet or axiom of Austrian economics that helps explain how Fed intervention into markets distorts them. It all of a sudden says we have this level of time preference that's low. Like we're willing to wait, we're willing to save. If our time preferences are low, then rates are high. We've got more money in the economy where the consumption is low. And so therefore it's free for entrepreneurs to go out. So rates are low. And then when the Fed jacks up rates, or when the Fed lowers rates, rather, it's saying, all of a sudden we want to consume today. So we're just really messing with time preferences and understanding that this matters and this isn't just something that's relegated to the Federal Open Market Committee. So
just to piggyback on that, and that's why, so when people would ask me, Rachel, over the past several decades, why do you like Austrian economics? My go-to answer was, I think they have the single best explanation of the business cycle that I've seen. So there's other reasons too, but in terms of what's the bang for the buck, what's the payoff, why go through this school where they don't rely so much on mathematical models, it's more verbal, and their framework is kind of more realistic, but it's more complicated. You can't get as crisp answers if you don't just have a simple model of the economy with a capital K for the capital stock in the Austrian view. It's more disaggregated. But the point is, the payoff of doing that is that you can tell a story where, the interest rate, if it's artificially low and doesn't correspond to genuine saving, gives like the wrong signal. That's the way you want to think about it. And that sets in motion an unsustainable boom. So maybe that's right, maybe that's wrong, but you can't even tell that story in some of the other schools of thought in their models, because their models are too stripped down because they want to be able to solve for the equilibrium point. So anyway, that's something that I think it's the Austrian school. Like, why should we care about this besides just some curiosity of the history of economic thoughts? Because I think, as you say, in real time, Mark Thornton has, if you want to go look it up, an article at Mises.org that was called Housing Too Good to Be True. And I think it was in 2004, where he pretty accurately, he wasn't just speaking in vague generalities. He was pretty specific about what the Fed had done, why housing was in a bubble, and then this is what's going to happen. They're going to have to come in and bail out Fannie and Freddie, and it came true. And as you said, Rachel, the conventional wisdom, it's not like everybody was kind of was open-minded. No, they were literally laughing in Peter Schiff's face in 2006 when he was doing CNBC and whatnot. And people just laughing at him when he was saying, oh no, housing's in a bubble. And so it shows that it's not that the smartest guys in the room really knew what was going on as of 2006.
Yes, and the quantitative models can be very misleading. As somebody who's built models, worked on models, me and my team found ourselves in an eerily similar situation in 2020 when the entire economy was locked down. If you can imagine, we were among the minority of economists who were shouting from the rooftops using this Austrian framework. So when the money supply started expanding, so let's rewind, level set for the audience, what happened? Obviously, everybody knows in March of 2020, we had the COVID-19 pandemic and global lockdowns. But that would have been one thing. In the US and across the world, most large central banks started having unprecedented monetary stimulus along with unprecedented fiscal stimulus. Now, you can argue that one goes with the other, that you can't necessarily have massive deficit spending without a buyer, i.e. the Fed or the central bank, buying a lot of that debt to be able to send out checks. But nevertheless, in March of 2020, we had a massive run-up over the next year of our money supply. And so it was very easy for our team. I work as an economist more from a risk perspective, which is very interesting because generally within banking and finance, a lot of forecasting, economic forecasting, tend to coalesce around a consensus forecast. Because the old adage, right? It's better to be wrong with the consensus than, wrong by yourself. The payoff, as you talked about, the payoff with the consensus from a forecasting perspective, it just isn't there to go out on the fringe and try to...
who could have seen this coming? Everyone else was wrong too. So,
so using the basic tools of Austrian economics, where an increase in the money supply generally leads to an expansion of credit, borrowing, and ultimately inflation. Because why? The structure of production was unchanged. Not only was it unchanged, it was the supply side. You could argue, as I mentioned earlier, we were on lockdowns. So a lot of manufacturing that, say, we get from China, all the ports were locked down. So at the same time, we had this unprecedented stimulus, a tsunami of money entered our economy while the supply side was locked down. And at the time, Jay Powell, the Federal Reserve Chairman, was saying that there would be, quote, no risk of going too far with monetary expansion. I'm paraphrasing, but I'm pretty sure that's close to a quote that he said during a 60-minute interview. There's no risk of going too far with the amount of money that we're pumping into the economy. So that's how Team Transitory came up. And I don't know if you remember back in 2020, 2021, Jerome Powell and all the Fed governors were going out doing Fed speak and going on road shows talking about, don't worry, this is transitory. So what does that mean for a financial services institution? What's the consensus? The consensus is that inflation is transitory. So why does that matter? If I'm a forecaster and I'm in the loanable funds market, or I'm a P&C property and casualty insurance company, I'm not worried about my costs rising. And if inflation is going to be relatively contained, then the Fed is going to keep rates low. There's no need for the Fed to increase interest rates. So what we were saying at the time, that was the consensus view. The consensus view in 2021 was that the Fed funds rate would remain or maybe go up to 1%. It was at 0, maybe go up to 1%, and then inflation would be around 2%. By Q4 of 2021, the actual inflation rate was around 7%, not 2, 7. And the Fed funds rate was around 3%, not 1. So that massive gap between what everybody thought was going to happen with inflation and interest rates caused massive losses among property and casualty insurance companies and banks. And what my team was saying the whole time, and how we helped our company, we ran stress test scenarios. We said, I think you're going to have a lot of inflation. And because you're going to have a lot of inflation, you're going to have higher interest rates. And that was, to your point earlier, laughing at Peter Schiff, we weren't laughed at, but it was something that we had to do a lot of writing to basically build evidence for the minority case that we were in. So here we are pulling charts of, if you look at a long-term series of real GDP and the money supply and inflation, you will find that those aggregates over time are eerily similar to the stagflationary period of the 1970s. In other words, we got a lot more inflation coming out of this 20% increase or $8 trillion that have been pumped into the economy. So yeah, we were on the forefront of that. And my final point about Austrian economics is, so the transitory narrative, a lot of people looked at specifically, I don't know if you remember, but the price of lumber skyrocketed during this time. It went up like 400%. And because it went up for a lot of reasons, supply and demand. The demand for housing actually went up during this terrible pandemic due to mortgage rates going down to sub 3%. At the same time, there were lockdowns and wood was hard to come by and transport across both the US states, but also across the world. And so you had this really big spike in lumber that stood out as from a commodity supply perspective. But along with that big spike in lumber, it went right back down. And so we're, being told, aha, you guys are showing lumber charts and that chart's going back down. And I said, okay, what would my basic, easy to understand Austrian economic framework tell me about the price of lumber? And I said, aha, Cantillon effects. So the Austrian School of Economic Thought it's a free market school of thought. So is, Milton Friedman, very sympathetic with his views on how money creation causes inflation. But the nuance that Austrians go a little bit further is they say, sure, money can enter the economy, but it enters the economy in an uneven way. So without a model telling me this, we were able to say and write and argue that we see that lumber prices have come down. Particular commodity prices are coming down. But looking at the structure of production, that's always the first to pop. Looking at Cantillon effects, we can forecast with pretty high confidence that we're going to see more inflation coming down. We don't necessarily know where. No economist can know these things. We only have to observe after the fact. But a priori, we know that we're going to have more inflation coming through the economy. And we were right. And like a very humble, and I say this because in a helpful way, using these basic tools of Austrian business cycle theory allowed us to make these calls. Yeah, I don't know which area is going to go next, but we do know that we're going to have this new money continue to filter through the economy. Oh, and by the way, what sectors did these impact first? Interest rate sensitive sectors. So what did we see the first to go when the Fed started raising rates to try to squash inflation that was not so transitory? We saw the housing market start to crash. We saw tech stocks, tech companies start to crash. And finally, we saw manufacturing companies start to crash. So the services side of our economy has held up really well. And that's because services industries are relatively more reliant on human capital and labor. So they weren't heavily investing in machines and R&D and these long-term processes that Austrian business cycle theory says that's the distortion. Back to Mark Thornton's book, a skyscraper takes years to build, and it pulls forward technology because artificially low interest rates allow that calculus to make sense at the time. But of course,
and also I know you know this, Rachel, but just to make sure the listeners are getting it, that with something like a skyscraper, it's not simply the time to complete it, but also the horizon over which you're saying, does this project make sense?
Yes.
There's a huge upfront cost to build a thing, and then you're going to get a flow of net rental income for whatever, 80 years or something, and then you're going to discount those cash flows. And so the net present value of that project being positive or negative is very sensitive to what discount rate you're applying to those cash flows over the decades in the horizon. Whereas some guy trying to say, hey, should I have a hot dog vending thing on wheels that I, pull up in front of Times Square or something, whether the Fed funds rate is 5% or 4% is probably not going to affect that calculus too much because it's a very short term, your capital's not tied up very long. You're buying the hot dogs and then selling them pretty soon or else they go bad. So, that's not a very interest rate sensitive enterprise where, building skyscrapers is. So that's why when interest rates are artificially low, you see a stimulus in certain sectors of the economy. It's not just a broad-based thing. And that's, again, what the Austrian School is able to even articulate, whereas other models that don't have a disaggregated sectors of the economy, it's just, there's consumption and capital, perhaps. You're not going to be able to get those nuances to say, which sectors are the most sensitive to interest rate reductions or hikes.
Yes. And then from there, you could pull that story forward and know a priori before the fact, there are going to be some malinvestments revealed once interest rates go up. So if you remember during 2021, there was a huge housing boom because along with Fed funds rate being dropped to zero, mortgage rates went to sub 3%. And we saw mortgage applications skyrocket, the demand for second homes skyrocketing, the investor share of the entire housing market almost doubled. I think Redfin had an article, it went from like 15 to 30%. And it goes back to why all of a sudden would housing become an interesting investment? You say, well, the Austrian business cycle theory, it's artificially low interest rates diverting resources away from what they were into housing. And why would they go into housing? Well, it's relatively risk-free compared to, say, a meme stock at the time. But also, there were no other trades. So treasuries were very, very low. I think the 10-year treasury got to like 2%. So, okay, unless you have to hold a treasury, inflation is eating away. So what this inflationary boom causes these malinvestments, and that's another tenet of the Austrian business cycle theory, is that, all right, now I know we're going to have inflation, but the story doesn't stop there. The Fed is going to have to unwind. Where are we going to find these malinvestments? Where did the money flow? So let's look. Let's put our investigative hat on as economists. Just look where the money flowed. So I could make the call and say, guys, watch out. The housing market is going to crash. Now, candidly, the housing market has crashed and prices are still up. So the housing market as of October now, 2024 is absolutely frozen. If you look at, say, a chart of mortgage applications, it's down to levels that we haven't seen since the Mortgage Bankers Association began charting mortgage applications over time back in the 90s. So although prices are up due to some supply issues, I would argue that the bust has happened in the housing market and prices are soon to follow this sort of low transaction that have been caused. And I think, Bob, that's the true nefarious part of this intervention, is that it fools people into thinking, as you mentioned earlier, that the profit is going to be there, that the consumption is going to be there at the end of the project. So investing in long-term tech, investing in building new houses, being a landlord, you think that the tenants, the rent, whoever, the customers are going to be there for the long term because the interest rate signaled to you that people were saving today so they could consume in the future. That's what low rates should signal. But they weren't saving, right? People are consuming more than they ever have. Consumption is at an all-time high, even when looking at, say, personal consumption expenditures adjusted for inflation. So people are there was a big jump in savings, but it was artificial.
Mm-hmm. Okay. Can I just pull a little on the thread there about the housing? So that was interesting. You said technically there's a sense in which the housing market has already crashed, but someone looking at prices will say, what are you talking about? And
Right.
let me run something by you, Rachel. I've heard people say, like, more anecdotally, I don't mean just a bus driver or something. Not that there's anything wrong with bus drivers, but I mean people who work in real estate, and they were saying, look, I can't speak to the nation. I'm just saying my local market, what's going on is. And their explanation was, because mortgage rates rose so rapidly, where normally you would think, if mortgage rates go up, that should push home prices down. Like, it's a pretty mechanical thing that, for a given amount of disposable income, how much house can you afford? Well, it depends what the mortgage rate is, that kind of thing. What's my house payment that I can make? And they were saying because mortgage rates rose so rapidly, it had this weird thing where, yes, the demand for new housing or even old housing, but new applicants, people who wanted to be new home buyers, put it that way, had fallen off a cliff because mortgage rates skyrocketed. But the people offering homes for sale also fell off a cliff because so many people had homes that were locked in under the low rates that they had for their original 30-year mortgage. And they thought, there's no way I'm selling now because I would have to get into a new mortgage where my rate would go up 4 points or something. That's crazy. Well, so if people had to move because of a job or divorce or something, they would maintain ownership of the property and just rent it out. And then they would go rent or something, whereas normally they would have sold and then bought a new place. So anyway, they were saying it's this weird thing where, yes, the demand for housing has plummeted, but the supply also, at least for this temporary thing where people are trying to hang on because they don't want to lose the old mortgage rates. Does that sound right to you?
Yeah, no, that's absolutely right. And because data can be so misleading, I tend to rely more on what I call annex data that you mentioned earlier. I think Henry Hazlitt's Economics in One Lesson, he wasn't an economist. He was more of a journalist, and he talked to people on the ground. And so I think that has power to talk to people. I go to restaurants and I sort of quiz the managers and the owners about conditions. But in the housing market, housing is almost a tale of two markets. So you have the existing housing market where what you talked about, people are effectively locked in, like a golden parachute to a 3% mortgage, let's say. And if they wanted to move, there's no way they could, because the math would be that they would most likely be paying a higher mortgage payment with everything included, because, as you said, house prices are high and mortgage rates went up so dramatically. However, on the new housing side, which accounts for roughly 10% of our real estate in America, that's almost a better leading indicator, or a better indicator of what's going on in the housing market. So new house prices have actually come down. And some could argue that, it's builders are adjusting for smaller homes. But nevertheless, new house prices are always a really good leading indicator if you were wanting to predict. Unfortunately, yes, there is this supply issue in the existing housing market. But when I say that the housing market has crashed, if you can't, once again, look at just the price of something to know what the health of that market is. The University of Michigan has a survey on the affordability or the conditions for buying houses. And if you look at that chart going back to the late 70s, the buying conditions for houses are at the lowest levels ever observed since the late 70s. And so that's when interest rates were very high. And so I think that reflects the sentiment of these buyers out there, both who are stuck to that 3% mortgage. That's a psychic negative. And Austrian Economics, I think, does a good job at saying, this is why we can't use models. This is why we can't just look at the price. We have to look at the overall standard of living, whether that be a psychic thing or whether that be a hard quantifiable data. And so the soft data, the survey data, are telling us that the housing market, once again, it's frozen, it has crashed, and it's all a consequence. It's not this random thing that BlackRock and Blackstone and all these big greedy hedge funds just all of a sudden wanted to become landlords. I'm seeing a lot about, and there's probably some truth to, no company is perfect angels, but why would, once again, BlackRock, Blackstone, Vanguard, all these big hedge funds want to have a bunch of homes on their balance sheet? Well, because they're seeking yield. There was a lot of yield seeking to artificially low interest rates. So there's always two sides to this coin. when you lower interest rates, it makes borrowing easier, but it also makes saving and investing less fruitful. And so, yeah, the amount of distortions that have been created from this will last, I believe, for decades. And so when we talk about economic forecasts and this tale of two economies, if we want to sort of get into, gee, why are we not in recession yet? All of this that you're saying, these malinvestments, the housing, manufacturing is in recession. Small businesses are in recession. So I'll pause there if you want to maybe talk a little bit more about my thoughts on recession.
Yes, I do want to transition into that. That's good. That's like the last big thing here to play a bit of devil's advocate. But before, I just want to underscore the importance of this theme of anecdotes versus, well, the macro data say such and such. And I don't have the full explanation myself, but I don't believe these numbers about the labor market and how great it is. And this is amazing. And look at it's anecdotal that I've known young people over the last few years that were trying to go get a job. And I would encourage them. And I say, yeah, go ahead and get your foot in the door now and put aside a minute, because I think I'm very concerned about the state of the economy and so on. So I was encouraging and they couldn't get hired. And like just one quick again, this is one little story, but she was trying to get a job at Friendly's and they set out some big bold letters, we're hiring. And I went in and I put on a tie and everything to be presentable. And I went in to talk to the manager and just kind of give I want to take an extra look at this application from this young lady kind of thing. And the manager just flat out told me, yeah, we're not hiring. And I said, well, the sign out there. And she goes, yeah, corporate told us to put that up, that we're not hiring. So that's what I mean, that like on the surface, wow, the unemployment rate's at historic lows, particularly on certain communities. And all these businesses are saying, hey, there's a labor shortage. Please be kind. People can't get people in here. That's why the services. And yet I knew people who, it's not like they had criminal records or something. These were perfectly nice kids that would show up on time and everything. And they literally couldn't even get hired anywhere. And it was just something was weird. So anyway.
Yeah, no, follow your intuition, because there are data that support that. So in our job, and as you know, as an economist, you never want to put your eggs in one macro data basket. And so when you do start to see some interesting trends coming from what you're referring to, the Bureau of Labor Statistics, both the household survey and the establishment survey, both of those make up the jobs numbers that you hear. Payrolls increased by $254,000 or 254,000 jobs were added last month, and the unemployment rate declined by 4.1%. That's a combination of two different surveys. And what's interesting is over the past year and a half, those two surveys have diverged meaningfully. So the establishment survey counts the number of jobs, the number of payrolls, the number of human beings on a payroll, where the household survey calls up roughly 60,000 households in the sample. And they say, hey, are you working? And how many jobs are you working? So what we're seeing is a divergence where the payrolls are outpacing. The payrolls look great. Where the household survey has stagnated, the number of actual human beings working, not counting multiple jobs, has been flat to declining. So we're seeing the quality of jobs that have been added over the past year and a half are mostly multiple job holders, part-time, and they're getting fewer hours. So why would this be? This goes back to which sectors are hurting. So back to, housing, manufacturing, and technology. In 2023, there was a slew of tech layoffs. So looking at data from Challenger and Gray, they have publicly available data. You can find layoffs from a lot of other private websites that have done a good job aggregating layoff data. That skyrocketed. And we thought, oh, here we go. Here's the recession. And then the tech layoffs kind of subdued in 2024. But now hiring data, as you said, hiring data is showing that hiring rates have hit levels that we haven't seen since 2008. And I'm pretty sure something really bad was happening during 2008, right? We were the great financial crisis then. So the labor market, regardless of what we're seeing in this BLS number that came out in September, it was pretty weak in August. September was suspiciously strong. And I don't mean that from a political perspective. I mean that from a pure mathematical and statistical perspective, that it was suspicious. And I'd imagine there'd be revisions to that number, as there have been downward in almost every month for the past 2 years. So it's my view, it's my team's view, that the labor market isn't a fantastic based on the quality of jobs, based on the ANIC data and low hiring rates. So if you're trying to get a job today, the data shows us that it's going to be a lot harder to get a job today than it was even a year ago. So the labor market has loosened in that perspective. There aren't all these employers scrounging to find folks to work at Friendly's, unfortunately.
Okay, so let me play devil's advocate a bit. And here I'm just giving you some of what I've been experiencing. That for a while, particularly like the inverted yield curve was my go-to thing. And I've written tons, and I won't repeat it for the people on this podcast because they've heard me say it so much, as to I'm not just like blindly following lines on a chart that don't mean something. Like I realize the historical pattern of the inverted yield curve, quote, signaling an impending recession, dovetails quite nicely with the Mises-Hayek view of what causes recession. So that's why I was comfortable with that. But anyway, that was kind of flashing danger for a while, and I was talking about it, and so far it looks like a soft landing. And you Austrian types, you're always screaming a recession. So once in a while you're right, but that's just because you're always doomsayers and perma-bears. And so you've been warning us about this one for a while, so why should we take you seriously? So I'm being deliberately provocative, Rachel, but go ahead. So what do you say?
Yes. No, I'm sympathetic to that view, as we have been spouting the same exact thing. And so what I'll say about that is, as you know, that the inversion of the yield curve generally leads 12 to 18 months of the recession. And generally, it's the uninversion of the yield curve that really matters when the Fed has to drop rates leading into a recession. So we did have an uninversion of that yield curve mid-September. I haven't looked
You're
today.
talking about the 10-year, 2-year spread, right?
Yes.
So that's the one, the uninverted, but the 10-year, 3-month still technically hasn't uninverted yet.
Right, sorry. Yes, the 10-year, 2-year spread, briefly uninverted. We thought, here we go. But then it reinverted again, because a really interesting thing is happening in the bond market. And so if you want to talk about that, we wrote a little piece on this where the Fed delivered a jumbo rate cut at its September 17th Federal Open Market Committee meeting. And the bond market responded by increasing yields. And so that wasn't really anticipated. And a lot of people were scratching their heads, especially as we work with mortgage professionals who have been dying for mortgage rates to go down to get production up. We got to, originate mortgages. And so our team has written about and warned that perhaps long-term yields have baked in expectations of rate cuts to where they're going to be, because that's what long-term yields are supposed to represent. The 30-year Treasury isn't based off, the Fed can't control the 30-year, the 10-year, it controls short-term rates. If it wants to try to control long-term, we're getting into QE. But as the Fed tries to control those short-term rates, they say, we're going to push the Fed funds rate down by 50 basis points. And so therefore, expectations theory would tell us that longer term rates bake in future expectations of where the interest rate is going to be at in 5 years, 10 years, 30 years. So mortgage rates were actually going down about 100 basis points, anticipating this Fed cut in September. And then all of a sudden they reverse direction. Mortgage rates are actually up from that meeting. And so it's anybody's guess, but it seems like the bond market is signaling that this sort of unexpected rate cut, the market was expecting 25 up until maybe hours or a couple days before the Fed meeting. And so this somewhat stronger cut signaled that maybe the bond market is saying, I think there's going to be more inflation. I don't think we've got inflation under control. So if you're a mortgage professional and you're really hoping for those long-term bond yields to come down, there's a lot of reasons why that might not be the case.
Right. Just intuitively, the central bank can print a bunch of money and buy bonds, and that standard economic view, even not just the Austrians, but more generally too, think, the Fed can push down short rates at least for a while. But if by doing so, they're creating a bunch of money, then that leads investors to think inflation in the long term is going to be higher than it otherwise would have been. And so you're going to build in more of an ask on the nominal yield on a 30-year Treasury or a mortgage, thinking, the dollars you're paying me back over the next 30 years are going to be weaker compared to the original trajectory. So that's why I'm going to insist on a higher nominal yield.
Yep.
So you get that seesaw effect. And that's partly, again, it's tying into why is it that, once the male investment boom is coming to an end, that you see the yield curve uninvert. It's because, the central banks senses the weakness. They see it coming. They cut rates, so that makes the short end drop, but it might even make the long end go up a bit because of the easier money. And so that's why the yield curve goes back to, quote, normal upward sloping configuration. Okay, so you had mentioned to me before in terms of our notes sending back and forth, that you think the federal funds futures market might be not giving the right view as to what to expect. Is that tied to what we're talking about right now?
Yeah. So as I mentioned earlier, during COVID, when the Fed was saying that they were going to keep interest rates low because their policies were not inflationary, the expectations were not for any rate hikes. And so we said, I think interest rates are going to be a lot higher because of these inflationary sub factors going on in the economy. So fast forward to today, where the Fed fund futures market, which is just basically investors trying to price futures contracts for what they think the federal funds rate will be at 1 month, 2 months, 3 months, et cetera. And so that's been pretty volatile. It has, because of that really good labor market report in early October, they've completely removed now one of the Fed's rate cuts by the end of the year. Okay. So what we're seeing is this theme where the financial markets are looking at every single data point for some sort of projection of what the Fed is going to do. The Fed has come out and said during the September meeting, their summary of economic projections, which is just an aggregated view of what all of the voting members on the Federal Open Market Committee believe certain economic data will be over the next 2 to 3 years. So when you look at their long-term Fed funds rate, they sort of inched that up from 2.8 to 2.9%. So with this jumbo cut, the Fed is signaling that, hey, I know we cut rates and that might surprise you. However, by 2026, we believe that the Fed funds rate is going to be 2.9%. So we're going to take a little bit longer to sort of ease policy. And I think Powell has been very clear. He's always been pretty hawkish on inflation relative to other FOMC voting members. So when we say that we think the Fed is going to keep rates higher than what the current markets are expecting recession with these rate cuts. But if inflation is turning around, and we believe it is, for the systemic risk of ever widening federal budget deficits, but also geopolitical risk is out there as well, which will cause some temporary inflationary bursts in our economy. The Fed isn't going to be able to cut, I think, what the market is anticipating. So our job as economists in a risk function is really cool because we can go back to that consensus forecast of, this nice soft landing, the Fed's going to get rates back down to 2% and inflation back down to 2%, whatever their neutral rate is, has a lot of risks. A lot of risk to that. And as I mentioned, the geopolitical risk, that's more of an idiosyncratic temporary event. And we can talk about that, like specific hard data, where we're getting that from. But also, I think the elephant in the room is the ever widening budget deficit. And I know we have an election coming up, but I don't think either candidate has put out any meaningful wish to really get our spending under control. So it goes back to Austrian business cycle theory. If you have consumption, i.e. money printing not supported by any production in the economy, you're going to have inflation. So generally, these stimulative policies are going to stimulate the consumption side. Fantastic. Just like during COVID, we all got our gaming systems and laptops and Pelotons. Who is going to make them? They didn't just magically print up large, massive manufacturing companies and factories. They didn't. It was incredibly easy to make that call that you were going to have inflation once again. And so fast forward to today, we're back at it. We're back into easy money. And what are the mechanics of how the Fed gets the interest rate down? Does anybody ask that question? I mean, they were doing open market operations for a while where they were able to, buy big and sell small. So if you wanted to expand the money supply, you buy treasury collateral from the banking system, exchanging one asset for another, cash. So now that banks have more cash to lend, thereby stimulating the economy. Now it's a little more gray as to how the Fed is going to be working this, because banks are so amply flushed with reserves that it's going to be more of a fiat decree. This is the Fed funds rate, and we will just decrease the reserves that we pay you banks that are parked at the Fed. We're just going to decrease the amount of interest we pay on these reserves to disincentivize you from keeping your reserves parked at the Fed. So now you're going to lend it out. Money's going to be a little bit easier. Financial conditions are going to be more loose.
Yeah, just to unpack that for the neophytes in the audience. So what Rachel's referring to is prior to the fall of 2008, the conventional way the central bank, quote, set short-term interest rates was just by adjusting the supply of reserves. If they bought assets, that would flood the system with more reserves. And if they wanted to tighten, they would sell off assets. The Fed would sell off assets from its balance sheet that would effectively destroy money, loosely speaking. And so the commercial banks would have fewer reserves to lend to each other overnight. And that's the interest rate on overnight loans of reserves is what the Fed funds rate is. So that's how they do. Whereas now, since the fall of 2008, they had this new tool of paying an interest rate on reserves. And so if the Fed wants to raise short-term rates to 4%, it just says to the banks, you keep your money, your reserves parked in your checking account with the Fed, basically, and we will directly pay you 4% on that. So any bank would be stupid to lend to somebody else at lower than 4% because they get a guaranteed for parked at the Fed. So that's the sense in which the Fed can now just directly set interest rates. But again, that's not magic. It's not costless. They have to create more money to pay them. You know what I mean? Mm-hmm. So that's why the Fed's literally insolvent in an accounting sense because of the rapid hike in rates, and they're sitting on fixed income assets. We just have a few minutes here, Rachel. I think you tantalized us with the geopolitical risk, so I can't not ask you that. So yes, just in the remaining time we have here, what do you see in that? So, because this is a lot more difficult than just forecasting what's consumer sentiment for my product next quarter. Like there's arguably World War III has already started. So what do you guys, how does that fit into your risk analyses?
Yes, I agree. There is arguably World War III. And so we obviously have the conflicts between Russia and Ukraine, which have escalated as Ukraine has now gone into Russia. So that's a heightened geopolitical tension in that area. But now we have, of course, Israel and Iran going effectively tit for tat, with Iran before was sort of operating via proxy terror groups within the Houthi rebels and the Red Sea. And also sort of zone in on that particular part and tie that back to inflation. So about a year ago, last November, Iranian-backed pirates, effectively, Houthi rebels in the Red Sea, were retaliating and attacking ships in the Red Sea. So these are large container ships that ship goods all over the world. And so this caused rerouting, higher insurance on these ships to move these vehicles across these waters. And so it resulted in the cost to ship, let's say, a 40-foot shipping container from Shanghai to LA. The average cost to ship that over the past 5 years was about $2,000. And over the summer, back in July, I believe that number increased over threefold to set nearly $7,000. Now it's come down just a hair. It's hovering around $5,500 to ship one container, 40-foot container of goods to America from China. The only other time that particular index, and you can look it up, on Bloomberg, and it's Drury Freight is the name of the company, and it tracks this data. The only other time that we saw this massive increase in shipping costs was during the initial invasion of Russia into Ukraine. And so there's actually research out there that shows that there is roughly a 9-month lag between rising shipping costs and import prices. And so we are in about month 3 from the peak of when we saw an increase in those shipping costs. So looking at that alone, we can say with almost certainty that we're going to have some upward pressure on import prices. Oh, and by the way, the U.S. imports about 70% of what we consume. So that's not a small number. That price increase isn't small. However, the understanding of inflation always has a monetary explanation or a root cause. So if that were the only thing that were to happen, a lot of economists talk about inflation being supply driven. This is a classic supply shock, like an oil shock. Mm-hmm. It's effectively the same thing. But if you only analyze the economy in terms of shocks, then the overall price level should remain relatively unchanged, right, Bob? I mean, that's like the number one thing that Austrians say, hey, a supply shock can't cause sustainable price increases of the average price level. that would only cause relative prices.
Right. Like if there's a frost that kills a bunch of oranges, orange prices might shoot up, and then consumers have less money to spend on milk. And so you'd think milk prices would drop. It's not that prices in general would all go up 20% just because the orange crop got hit.
Yes, but you would be surprised how many blamed inflation on, quote, just supply shocks alone. And but then how did the price of everything go up? So although I am describing the supply shock that is real, I believe it will be temporary in nature. And the only way that we would have sustainable increases in overall CPI or overall consumer price inflation is if we have this supporting deficit spending and easy money conditions, which for all intents and purposes, as I explained earlier, is heading toward a more easy loosening condition. So geopolitical risk is important once again, but I believe it's only going to be a temporary but still meaningful impact on particular sectors.
Okay. I imagine, though, that there's a feedback loop there where are they going to really be watching the deficit like hawks if Israel and Iran are like bombing each other? Probably not.
Probably not. No,
so that the things all kind of do go together. Okay. Well,
our deficit is at a level as if we are in a war.
Right. And I mean, just on that, the last fiscal year, just for people who this wasn't on your radar, the U.S. government spent more on interest on the outstanding debt than they did on the military.
Yes.
And so that's something that 20 years ago, so if somebody said that, hey, if we don't get our fiscal house in order, this will be the case, they'd be like, oh yeah, that would be insane. Don't worry, we'll fix it before that. And no, we're already there where that thing that would have been inconceivable 20 years ago just happened last fiscal year. Okay, well, we got to stop there because of the clock. Folks, my guest has been Rachael Medlin. Rachael, thanks for telling your story. It's always good to see how Austrian economics in the real world gives a comparative advantage. So thanks for taking the time to come tell us a bit about your work.
Thank you, Bob. And I owe my thanks to you for being somewhat of your disciple in a way, and all the other really great Austrian economists that have helped me and explained it well. And I just came on to show that you can be an Austrian economist in the real world. And you asked earlier about having an edge. And so hopefully, I wouldn't say I'm smarter than anybody else, but I have a heck of a framework and a heck of a theory in my back pocket to support a lot of the consistent way in which I analyze the economy. So thanks for the opportunity.
A sure thing. And I appreciate the kind words. And thank you everyone for tuning in. And you're going to be just as well equipped as Rachael. So thanks for tuning in. We'll see you next time.